Good morning, good afternoon, or good evening, depending where you are on the planet. And welcome to the Monday, the 7th of October, Bull versus Bear webinar. Steve Miley here on the call for Trade Day. Welcome, everyone. Going to go for our usual Monday run through here today, which is a bit bigger picture, taking a look at the shape of the week. We'll run through all the macro fundamentals, central bank geopolitical events that are potentially going to shape and have been shaping financial markets over the past week and going into this week. We'll also take a look at the calendar and a dip into some of the technicals as well. So starting off on the macro matters. Now you can get this in the columns below you. Three columns. Left-hand column is the technical analysis. Middle column is the fundamentals. The fundamental analysis that we do every week. You get both the macro matters, which we have here, and then also the weekly recap and update. If you want a shortened version of that macro matters, if you want the more in-depth, go through the macro matters. We also then have on the right-hand column the news from our partners at Live Squawk, the Squawk service. So you're going to run through this. So US stock indices and bonds yields higher. Stock indices only edging higher, significant move higher in bond yields, and they continue to climb. The 10-year note got up to 398 on Friday after that jobs report. We'll talk about the jobs report in a second. But they're up to 398, through 4% in here this morning. Also a sharp rise at the short end in here. All of this is on the back of the jobs report, and I'll come to that shortly. Stocks in here edged higher, weren't particularly higher in the week, less than 1% higher for the S&P and the Dow, but nudging up to record highs. The Nasdaq still stays some way below its record highs. This despite obviously growing tensions in the Middle East, but Chinese stocks continue to drive higher in here. So let's take a turn to look at the Middle Eastern tensions. Ongoing tensions, further rocket exchanges more recently in the last 12-24 hours being exchanged. Nothing with a retaliation from Israel to the Iran missile launches from last week as of yet. So we'll see if anything's going to develop on that front. At the moment, nothing. But also Brent crude oil surging higher and continue to go higher in here this morning, which could be a drag on obviously economic growth going forward, and obviously creates confusion, and markets don't like that confusion. U.S. employment report, however, on Friday showed real strength. Not only did it come in at 254,000 above the 132,500 expectation, but also August numbers revised up, and July's also. So July and August numbers revised higher. So all of that adding to a super strong jobs report, and that's caused markets to now anticipate less chance of more aggressive rate cuts from the Fed. It's also meaning that we probably won't get this hard land in the markets, or some analysts have been fearing. Less chance of a hard landing, more chance of a soft landing. So that means soft landing, we don't go into recession. Growth numbers staying firm, the labour market staying firm. Inflation obviously continues to tick down, and we'll come to that now. We have the US CPI data coming up on Thursday. That's going to be super important this week. Ahead of there, we do get the Fed's minutes meeting from the meeting for when they cut rates. So we might get some more colour on what their thoughts on future rate cuts might be in here. So yeah, all of that important in here. Obviously, rate cuts are still on the agenda, but now really, I was saying actually last week, we'll come to the Fed Watch tool shortly, but the market was pricing in basically like only 25 basis points at this meeting, and up to 75 basis points by in the November meeting, and then 75 basis points by the end of the year, which would be very odd for them to go 25 and 50. Market is now pricing in 25 and 25, which is far more realistic, and I wouldn't be surprised if that's how we go into the end of the year, and the market should be happy with that. The main central bank activity is the minutes we get on Wednesday, as we have already mentioned. The main data is the US CPI data on Thursday. For today, little out of the US. Will come to the calendar in more detail shortly. German factory orders, EU retail sales this morning, UK retail sales, RBA meeting minutes, and German industrial production tomorrow. So some light calendar for the beginning of the week out of the US. Then we get the Fed minutes, and then all eyes on the CPI. So a very light calendar you can see for the US for the first 3 days of the week, and ahead of the FOMC. So it could be a relatively cautious beginning to the week, I think. And we'll talk about that a little bit going forward. US CPI on Friday. Then we get German CPI. That could could be important. GDP and industrial production, Canadian employment reports, usually on the same day as the US employment report, but lagging a week behind at the moment. And the US PPI shouldn't do too much given that you have the CPI just before that, but can be a reinforcement sometimes of the CPI data that we get. So all eyes really on CPI. And it's a very light calendar. There's the weekly recap and update. A very light calendar. You see, it's a Chinese holiday in here today. We haven't got. We've already had that European data that I had mentioned just there. We do get Fed speakers, and this is going to be super important. Obviously, on the back of the fact that we had that really strong jobs report. So we're really watching out for the Fed speakers ahead of the Fed minutes on Wednesday. Bowman, Kashkari, and Bostic all speaking today. So watching out for Bowman, 1:00. Kashkari at 1:50, Bowman at 1800, 6 o'clock. These are all Eastern time. Those are going to be the key events, but no data today and no data tomorrow. I think that's correct as well. Nothing of real note. Yeah, US trade data in here. Yeah. So nothing really. Bostic speaking again tomorrow. So the next 2 days is very, 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 very quiet on the data front. So that could just mean more of a consolidation. However, we are definitely watching. We could get some movement on the back of these Fed speakers that we have coming through the day. The other thing that I actually neglected to put into the macro matters and the weekly recap and update is we're on the verge of earnings season. I thought earnings season was kicking in the week next week, so I was going to start to focus on that in the weekly reports, in the weekly update, and in the macro matters. However, it is this Friday. So you see in here, nothing really. We've got PepsiCo actually coming up on Tuesday. Not usually a big mover for the broader markets, but we do get the banks kicking in on Friday. So from this Friday, JP Morgan, Wells Fargo, Bank of New York Mellon, and here all reporting. That could herald some movements in the market, particularly with CPI the day before. So Friday's big focus is going to be on those CPI. Thursday's focus on CPI. Wednesday's focus on Fed minutes. Thursday's focus CPI, and then we get earnings season. And we'll really drill down into earnings more as we go into next week, and we'll have a little bit more of a look at that. But certainly watching out for these earnings reports. These all come before the bell on Friday, but we'll focus in a bit more on that closer to the time. Let's go to 5 things to start your day. The focus here from Bloomberg is on the 10-year yield moving through 4%, its highest level since August in here after the strong jobs report. Most of that move coming on, most of that report being digested on Friday, and we moved up to 3.98% on the 10-year and up through there today on the overnight up into 4%. So just a psychological round number in there. Stocks lower in here this morning on the back of both the ongoing tensions in the Middle East, but also on those higher yield. Fading chances of more aggressive rate cuts. We're not looking for another 50 basis point. And oil, another, pushing higher as well, continuing to push higher, is causing issues. Despite the short-term knee-jerk reaction to actually, so obviously on Friday we went actually up. We're higher on stocks and we're back lower in here this morning, and I say I think we're going to see a choppy couple of days in here, at least up until the Fed minutes. But the Fed speakers could alter that. I've got a slight positive bias. I think we still go push to those all-time highs on the S&P and Dow, and pushing to new recovery highs back up towards the old highs from this year on the Nasdaq. But I think it's going to be more of a grind higher. I think it's more of a consolidation grind higher rather than impulsive moves higher. Given we've got these 2 significant events this week, and also the earnings season kicking in on Friday. So I think the beginning of the week is going to be relatively quiet. Bigger picture, though, the fact that we're going to probably have a soft landing, that we've got rate cuts coming, probably going to get a soft landing. Inflation's coming under control. Is a really a bullish outlook on the longer term. And both Morgan Stanley and Goldman Sachs in here bullish on US stocks on the back of that robust labour market. Goldman also upgraded its call on Chinese stocks in here, so that looking positive if they deliver. And that's kind of reiterated in across all of that I've just said there in all these headlines. So stocks drop, US yields go through to 4%, rate cuts bets ebb. So which means not that we're not going to get the rate cuts, is that we're not looking for that another 50. Oil prices up through $79 on fears of Israel strike on Iran, and similar across all these. Monster payrolls sees 10-year yield top 4%, come from Reuters. Key US yields hit 4% for the first time since August on Fed rethink, so not as aggressive, not as a dovish Fed expected. again, it's all about the yields. 10-year yield hits 4%, keeping equity bulls in check. But ultimately, this is kind of positive, right? The reason we're through 4% is because there's a positive outlook on the economy, that we're not going to have a hard landing, which is longer term positive. Short term, though, the knee-jerk reaction has been down. Brent crude is through $80. WTI 79, as we said. Brent crude now through $80, and bond traders buckle up for no landing. So not a soft landing, not a hard landing, just a no landing in here. A situation when the US economy keeps growing, inflation potentially reignites, and the Federal Reserve has a little room to cut interest rates. It's largely disappeared. Okay, and as bond take talking points, so it's only a blowout payer has brought to revive it. So there you go. Goldman cuts probability of a US recession in the next year to 15%. That's the long-term average. That's what the 15% is, where the normal, where it just sits anyway. Goldman had seen a risk of 25% in early August, and now only looking for a 15%, which is the long-term. That's where the average is. Look, the long-term average for whether or not there's a recession in any year sits at 15%. So basically, they're not expecting a recession. Asian stocks are actually up on the overnights, Nikkei and Hang Seng, where European stocks in here mixed, with the FTSE 100 UK index up about a third of a percent, just under 0.2 down for the German DAX, and the French CAC unchanged, whereas US stocks on the futures down between 0.5 and 0.6 on the S&P, so just under 0.5% down on the S&P and 0.6 down on the Nasdaq in here this morning. Let's take a look at the Fed Watch tool in here, the CME Fed Watch tool, and you can see now this has leapt up significantly. This is now only a 25 basis points, so very little chance in here now. So unchanged. This is for unchanged now. This wasn't even a factor before, and remember we had another column for 50 basis points. The market is not pricing in any chance of a 50 basis point cut now, only pricing in a 25 basis point, and tried pricing in 12% that they don't cut rates at all. So a massive shift in here. We were pricing in basically at least a 25 with a good chance for 50 now, and maybe even more, and now we're charging it, and we weren't pricing in any chance of unchanged. Now we're pricing in a chance of unchanged, but pretty much nailed on that we'll get 25 at the next meeting. And now you see how this has changed massively for the end of year. End of the year now pricing in pretty much nailed on. We get a total of 50 basis points, so 225s by the end of the year is being priced in. Yields we've already spoken about, topping 4%. You can see went up close to 4% last week and on Friday, and now matching this swing peak in here from back in August, up just above 4% in here this morning on the overnight. And US Treasury yields, this is without the overnight data, but getting smashed lower. And the important thing is here, look at before we were seeing more negativity on the long end. Now you're seeing more negativity. Look at that plunge in the 5-year. Look at the plunge on Friday in price. That's lower prices, higher yields. This is on the 2-year. This is the unpricing of more aggressive rate cuts that you can also see there on the Fed Watch tool. But stocks remain positive. You know, we saw a firm bouncing here on the S&P 500, back up, closing at or near the all-time high. Nasdaq moving back up close to the recent highs. Yes, we're back low in this morning, but I think we could easily chop in this little range in here. I think we could just be a little bit sideways city over the next couple of days. My bias is still to the upside ahead of the FOMC meeting minutes, but it's going to be really, I think, the interpretation. Some of the watching out for the Fed speakers over the next couple of days to see if they're looking at this. Yes, okay, the jobs data is good. Yes, that's good. It means we're probably not going to get a hard landing. We're going to have a soft landing. And what does that also mean? Does that mean that they will continue to be more aggressive or less aggressive on rate cuts? And I think that's the tone we need. If the Fed are now saying, well, you know what, we may not need to be as aggressive. You know, if that's what we get from the Fed speakers, a slightly less dovish, de facto, more hawkish tone, then it could mean that then we see stocks actually get injured by that. Okay, because even though the reason for this is the economy is good, the market wants a more dovish Fed. Okay, and if the Fed back away from being more dovish, the market's not the market. When I say the market, I'm talking about the stock indices. The stock indices won't like that so much. All right, guys, I'm going to wrap it up there. I'm going to wish you all a great trading day. Take care, stay safe. I'll be back with you with another Bull versus Bear webinar tomorrow. Bye.